Welcome back to the Kingscrowd Podcast. I'm your host, Brian from Kingscrowd, joined by Scott Kitun and Teddy Lyons. Today on the docket, we got a couple different things we're going to be talking about. One of the biggest things in the news that everyone's talking about, SpaceX. We want to break down some of the different exposure to SpaceX that investors had pre-IPO and how that worked out for those investors, whether it was through mirror tokens or some of these other vehicles. Then in the second segment with our senior investment associate, Teddy, we're going to be breaking down a deal review, Rejuvenate Bio, currently raising on Wefunder and one of the biotech deals that the fund is currently assessing. All right, let's kick things off with Scott. Scott, in this first segment, SpaceX. Man, I feel like my podcasts and news and everything has just been about SpaceX for the past week.
I mean, that obviously it has. I mean, that's all that Twitter is right now is SpaceX. It's funny because it's one of those things where everyone who, and we can go through the gamut of where they got in at, but let's just assume you got in early, like some of the wealthy, the Zacks of the world and all these guys, like, or Valor, obviously, at the beginning. They obviously all win. Huge win. We can talk about the big win. For those who came in secondaries, it's mostly a win. For those who came in Mirrors of the Republic, it's a win. I never really no doubt that was going to be the case. And we could talk about some of the secondary allocations that are questionable, and the Binance situation where they promised an allocation, but they didn't get the allocation. And that's because everyone started to realize that this was going to be a success. And so they started being more selective. And that's when they brought in 27 iBankers to do this deal. And it is a whole thing. My concern was really, and I still, on paper right now, I'm wrong. Time will tell. I was more concerned with the retail investor buying on the IPO and taking the bag of sand that gets everyone else wealthy, and then they're holding on for this until it is worth $1 trillion or $2 trillion that they're claiming to be. The numbers, there's several investors who've said this, so this is not my own creation, but I do think it's true. It's like, if you believe that this is a 20, and we might have talked about it on the last podcast even, if you believe this is a $20 trillion opportunity with data centers in space and all this other stuff, and now they just announced yesterday, that they bought Cursor on the $60 billion offer sheet. If you believe that this is, and I also, by the way, everyone knows that Elon Musk's X.com was because he believes that the evolution in America, but also globally, is that it'll be similar to China and that there's an everything app. And if the everything app of 2050 is not the everything shopping app of 2020, it's I get my power, I get my work, I do this, I ask questions, finances, everything is done through one app. That's what he's building. And if you believe that there's a $20 trillion company that's launching rockets and colonizing Mars, and that we're taking 1% of the sun's power to populate AI for eons and eons, as he said today, if you believe that, then no price at this point matters. Whether it's $1 trillion, $2 trillion, $500 billion, $2 billion, $20 billion, it doesn't matter. Because we're going in this direction over a period of time, and we're talking about 5s and 10s and 20s of years out. If you don't believe that, and you believe that the company is as good as its revenue, and that potentially there's an AI bubble and that maybe things aren't going to be so great, then this deal is fucking terrible, and it's marked up insane. And every retail investor who buys right now at launch, again, I'm pretending that we're not a week in, that buys at IPO is going to get destroyed. I had taken the middle. I believe that the 20 trillion opportunity is probably true. I don't know yet about the rockets, the data centers in space and other things that we've talked about. You're literally a rocket scientist, so you would know more. But I take a middle ground, which is to say their revenue should be over indexed because we're talking about stuff that's never been done before. It's not the same thing as saying, what's a 20 multiplier on a SaaS company? Because you can look at 50 SaaS companies before you and go, it's too high, it's too low. What is too high? What is too high in the future of the freaking universe? You tell me. I don't know. So is it too high? Of course it's too high. But what is the right number? I don't know that number. And so I took the middle ground of I think that retail investors who buy this today, my feeling was that in a week from now, the stock would start to come back to reality and then eventually crater, and you'd have about a 45-day, 30 to 40% of its value gone. And I was wrong about that so far because it's up like 35% since IPO. And maybe more than that now. It's 25%.
Actually, yeah, as of today, currently trading at 202 from 135. It's up about 50%. It actually hit a high at 225 today.
Yeah. So there you go. So like totally wrong, Jim Cramer moment, totally wrong, but not wrong. I'm going to hold on to this, and it's not out of like ego or arrogance. Like, I don't believe I'm wrong in the narrative. And this is like to steal an Elon Musk-ism to use on Elon Musk. I believe I am directionally correct, and I have been directionally correct with all of these Elon companies. I'm long in them. I love them. I believe in them. That doesn't mean that I'm blind and I don't understand where Tesla's overvalued, but I know why I think it is valued as it is. You know, my main investor was Valor. I'm privy to a lot of information on these things because my main investor is the lead investor of SpaceX. Like, my investor and board member is John Shulkin, who is the person who's on the board with Antonio Gracias of SpaceX. Like, I know these stories. I've been long in these companies, but that doesn't mean that it's a great deal for a retail investor today. So if you got in, I was wrong. You were right. You sell your shares today, tomorrow, the next day, up 50%, up to whatever. Maybe it slides a little, you sell at 25. You will have done well. Everyone who is in when they're private has done well, except for the stories we'll get to, which aren't even bad stories. They're more just you didn't get what you thought you'd get. For those who are buying now, who are retail, and we talk about this so much on this show, if there's anything you listen to in this rant, please be this thing. Do not panic sell, because it is going to go down. I do not believe that I am incorrect. Directionally, I believe I am correct. This will continue to go up until it finds a point where it's like a parallel universe and everyone's like, what the shit is this? At some point, it's going to have a realization moment and everyone's going to be like, oh, okay. And the institutions who bought big chunks in the billions of IPO are going to release and rebalance and take 40, 50, 60% of their earnings off the table, and then they'll come back later when it dips. And the people who generally panic sell here are the retail guys who bought all the paper. And I would just urge you, if you bought this because you just short term, you think big time deal, cool IPO, take your freaking winnings off the table right now so that when you panic sell, which you will, you don't lose your gains. For everyone else, if you believe in what got you here, hold. It's going to go down. It's going to get cut in half, maybe more at some point. Maybe it's 2 years from now. I don't know. At some point, hold. Because if you believed it was a $20 trillion company 3 weeks ago, believe it's a $20 trillion company now until that's not feasible. And that would be my thesis. I think that this is ultimately my entire worry was that retail was going to relieve all of the rich guys and give them their money, and then they were going to get fucked. And it didn't happen that way. It's been the opposite. They've made money. Elon has a weird ability to like shift the universe, and he did it again.
A lot of things to say. It's hard. You can't say you're wrong. It's the third day of trading. It went public on Friday. So yes, okay. The first few days there was
right, Brian. How many companies have we talked about that go public, and everyone's like, "Oh man," they buy it up, and you see it go through the roof, and then within a week, it's just cratered because it was all hype. We've seen this before, Brian. We've seen companies go live, have an IPO, lots of hype. They look good. People buy it when they're excited, and then they have a chance to sit on and sleep on the actual multiples that they bought at. And it hits a certain point where it just starts going backwards. And once there's a regression, it just goes off the sayonara, off the deep end. Go Health is a local Chicago example of this. It happens. All I can say to you is I didn't anticipate it like cutting in half day 2, but I didn't anticipate that it's up 60% 2 or 3 days after an IPO that was already basically called too rich. So it's like, it's not a normal deal where it was like, was it priced too high? Was it not priced too high? And then it goes up. It was priced too low, but actually that's now too high. It's not that. He threw a price out. And at the time, I really believe this. Matt Levine, which we read, said the same thing. This is Elon's ability to manipulate reality. He picked a number. I don't believe he had any insight. No one knows what this number is the right number. He picked a number, and then the demand fulfilled that number. And it turns out that the demand is in hundreds of billions of dollars more than even the IPO. They're still right now today at 155 or whatever you said it is, 205. There's demand. We saw this with Tesla, by the way, not at the IPO. We saw this at Tesla at the end of COVID before the split. It was a good company I had invested in, and that basically bought my house. Was my investment in Tesla from IPO to date. It was the split that was the craze from COVID, which had this same crypto-like behavior, which again is an Elon factor, and again, wasn't wrong. You would have said after the split and after all the things that happened with Tesla, somebody would and it's obviously come back and then through the roof again. Somebody would have pointed out the fact that it's worth more than every single automaker combined, and that makes no fucking sense. And yet here we are, it's still going up. And the reason is because it is not like any other automaker. It's not an automaker. It's a transportation power energy company. And this space is a interplanetary energy travel company.
So a lot to understand about IPO mechanics, right? When a company goes public, there's supply and demand, and that IPO price depends on supply versus demand balance. And what we saw is that a lot more people wanted in than there was supply. Now, part of that reason you need to understand is that the number of shares that are currently being traded is not all of the shares that are out there that are available. Right. It's a small part of that. And then over time, right, as certain milestones are hitting different things, more and more shares are going to become unlocked, which will add more supply of shares.
Yep.
That's more opportunity for some of those insiders to sell. Now, that being said, right, Musk obviously is a huge holder himself with a lot of his shares, but it's something we've seen with not just online private market IPOs, but like IPOs in general. I remember like one of the first, I won't say I traded in it a lot, but like I remember the Facebook IPO in 2012. And that was like one of the hottest IPOs of the time. I think it was maybe the or one of the biggest tech IPOs up until then. And there was like such hype around it. Very shortly after it went IPO, I remember it crashed. I remember if it was 50% or what. And it had this long lull for almost a year versus you look at where it is now, right? So it's so hard to extrapolate out and say, is this, like you were saying, Scott, is the 5-year, 10-year, 20-year? Yes, I think, these are all things that are moving in that direction, but it doesn't mean that day 3 of trading that it's up 60% or 50% or down 60%. That's not indicative of the future value.
I agree with you 100%. And this is part of why Kingscrowd exists. And I hope this show exists. And I hope people listen to this for this and not just the rants and the random curse words that I throw out. What you're describing is multiple versions of an investor. Like to me, the type of investor I am, I'll do swing trades here and there, but it's really because I heard something or I'm aware of something and I'm just trying to not insider, just be clear. I heard things that make me feel like this is moving. So I will do that occasionally, and I'm not a big fan of it. I may make decisions long hold, ride up, long way, ride out, lull, buy more, lull, ride up. I've made conviction. I already decided that this is going to be a thing. And then the only thing that pushes me off of it is something that happens with the company or the market that I'm like, oh shit, things have changed. So I'm out, and you lose sometimes. The point of this is, for me, the number I want to get in at is closer to $100 a share or even under $100 a share at the current share structure. So I was hoping that this would go public at 135, it hit 155, 160, and then it would go 130, 120, 110. And then once I get the alert that says it's hit $95, then I buy, $10,000 plus worth at a time. And I feel comfortable there. And it'll probably end up going down as low as $70 or $65 in my brain, just because the market's not today, just in a year or two. And I would buy some more there. And now my net is somewhere $85 to $90 a share. Now I'm going to ride this wave for 6 years until it reaches 1,000 and then it splits and then it's worth whatever. That's the way I would trade. You're describing someone who theoretically, if I believe that it's worth 20 trillion, it really doesn't matter whether I got it at 135, 100 or 170 or 200 or 210. None of that matters because at 1,000, it's amazing. If you're a person who believes it's a $5 to $10 trillion company, that $60 swing matters. That's all my take home. So to me, I've said to you already, I believe that I I can buy into your $20 trillion idea. But to me, I think it's a $5 to $10 trillion company pretty safely. And so at that price, 135 is a little rich. I also know it's going to go down at some point, so there's no hurry. But like, I would like to see it under 100, because then I see nothing. I get 3x basically, no problems. And that is, we're not talking about SpaceX here. We're talking about a type of investor. We're talking about a strategy, a philosophy. And I think the problem with retail is that most of them, whether it's because they're hobby investors or because they just don't generally get exposure to stuff like this. This is a very exciting company to go public. This isn't a fucking shoe company. This is a intergalactic company, with one of the most famous faces in the history of the universe, our modern Howard Hughes. So it's unique. Retail investors are coming into a place that they're not super familiar with, and they're playing. My fear is still a little bit that they're playing a traditional market game with a company that is more like a crypto bet. The behavior is more like crypto, so be careful. And there's a lot of very, very wealthy people who stand to make a lot of money in the first few releases of shares. So be careful. Is all I'm saying. And I think this to me, this is just the beginning, right? Because like Anthropic is a similar situation. It doesn't have the Elon factor, but it's got the Dario factor, which is a government thing. And you've got the government saying basically he can't do certain things, whatever, it's adversarial. They can change the value of that company pretty significantly. Then you got OpenAI, who's next behind it, which to my understanding, I know Anthropic is caught up, but OpenAI may have the most private syndications of like syndicators and secondaries invested in it of any private company ever. And so now you're talking about another kind of type of IPO, which has very different ramifications, different groups of people. We're going to start seeing a lot of this. Stripe will be next. Like, we're going to see a lot of these companies, and a lot of these AI companies are going to give way probably to another SPAC world, where like people are creating these companies to be able to acquire 15 other AIs and roll it into, whatever, on and on and on. We're entering a new era, is my point. And the SpaceX to me is just the tip of the iceberg.
Yeah. I love what you described there, because it's a plan going in. You have a strategy that you thought of. You're not reacting, right? When people get reactive, this IPO is coming. Yeah, I'm going to go buy it. Oh my gosh, it's crashing now. I'm going to sell it. If you have a plan in advance, when you're more level-headed, more cool-minded, that is like the difference between a successful and unsuccessful investor a lot of the times, because like you just laid it out there, maybe it happens next week, maybe it's next year, it's something else, but you know that eventually, right, things are probably going to level out. It's going to come down to a more rational price. Maybe it doesn't, but there's always other opportunities out there, right? You're not going to be right 100% of the time.
All week, I wanted to buy this all week. Monday, Tuesday, Wednesday.
You've avoided the FOMO.
Why am I not buying it? But
yeah. And especially you hear these stories, like people were, the number of retail investors who are saying that they tried to buy 8,000 shares, but they could only get a loan for 1,000 shares. Or like they said, I saw this quote from this person. It was basically, I don't care what the price is. I just want to be a part of it. Like that's the type of people who are investing right now, which be sending off little alarm bells. Because of the way that IPOs also work, the investment banks need to price it so that it has the nice pop, so it looks good. What happens after that? They don't care. So,
this is textbook.
I think
they've crushed it. Whoever was designing this, just like Tesla's second reboot, deserves a massive pay raise. They crushed it. Like I said, right now, again, you called it, right? Reactionary. All the reactionaries on Twitter who are like, we won. Like if you cash some money out, then you definitely beat me. But like right now, you could say that all you want to. I'm holding firm that I will be buying shares at $75 in within this year or next year.
Yeah. So why are we talking about all this? Obviously, this is a great example of, I think, a lot of these private companies that are becoming public. If you're an investor in any of these companies, this is something you have to deal with. Like your companies at some point will get acquired. You'll have to make a decision. Do you hold? Do you sell? It's going public. And I think having an understanding of this IPO process and just the way that this works, like how does the whole roadshow work with a traditional IPO and the investment banks and the way they price it? Like once you understand the incentives there, you can make more informed decisions. And I think I tend to be aligned with you, Scott, and we could both be wrong. Like it could just go up for a long time from here, right? But I think you can't look at history with the 2020 hindsight of, oh, well, it worked out exactly as I expected, because percentage wise, if you're doing this a bunch of times with a bunch of companies, you built a portfolio, you're going to see it go both ways. And honestly, I could have seen a crapshoot. It could have been down 50% the first day or up 50% the first day. And I just decided for myself, I'm going to let it settle out. I'm not going to be a part of that. If I miss out the gains, cool, that's fine. I'm not going to worry about it, right? But just to talk about a few of the things, because I think I want to, we brought this up at the beginning. Mirror tokens is something we spoke about a few months ago now on the show. And there was a whole question about, is it going to work? Are they actually getting any allocation? Saw a post from, I think it was Republic Europe or Cedars, but, basically according to them, the split adjusted price of the mirror tokens was $55. They basically all got cashed out at $135 per share on the IPO day. That's awesome. Like 1 year, 2.5x return, good for them. The thing to understand, if you're an investor, you're probably like, hey, this is awesome, but like, man, I missed out on another 20% pop on day one. So that's why you got to understand what you're investing in as well, right? Because I'm sure if you read the contract or the way the mirror token were set up with those terms, if you read about it, it probably said that you get cashed out at the IPO price at the day of the IPO, right? Which could be great because that could also protect you from the downside. But, I think that was something that a lot of people in the industry were questioning about, like, was it actually going to pay out or not? And that one ended up working out. Story of some of the ones that didn't, as you were alluding to, Binance, I had to look this up, had over 557 million in USDC deposits for SpaceX shares. So almost, huge, $500 million all got canceled, got refunded basically because the provider, the primary issuer that was X stocks, I believe they're owned by Kraken, failed to deliver the underlying shares. So this just goes to show you that even if you think you're going to get an allocation, there's always that counterparty risk. You got to understand what you're actually buying into. Now, this was not a fraud, right? Like these people supposedly got refunded their money.
Everyone was aware that this is possible. It said it very clearly that this was based on availability.
Yep, based on availability. There were a bunch of other ones that also got canceled, but I think just to your point, Scott, there was and still is huge retail demand for this. There are all these different ways of getting access to these shares pre-IPO. So we've talked about a bunch of them in the past here. There was mirror tokens here. There were SPVs. A lot of the retail brokerages even gave allocations to some of their investors. But I think you just need to understand what you're investing in, right? As we always talk about in this show, they all have different ways of getting exposure. I think some of the SPVs are still TBD of like how those ended up working out for people. I want to see kind of the math of the waterfall of all the fees that people are paying and what they actually got paid out, if they even got their shares. But yeah, I don't know. Anything else to add just in terms of like getting exposure to companies in the different ways?
Yeah, I mean, first off, good news. This isn't going to be the last opportunity. The mirror for Anthropic, the mirrors for OpenAI, the mirrors for Strike, there's a handful. Ramp, I think, is one of them also. Like, there are plenty of opportunities coming. IPOs will not, we're going to probably see a wave of them, but there's not that many great companies that are going to come out that I'm like, damn, I need that. It's not that there's not a lot. There's a handful of them, but it's not like the olden days where it's like you'll have 15 versions of Salesforce come out. So it's like next week. It's not like that. There's only a limited amount that are going to get this kind of attention, but there are plenty. Neuralink and Boring Company will be the next one that if you're waiting for another Elon play. There's a couple pieces here. One, on the IPO thing, totally true. Read your contract. Thank God we've got Harvey and OpenAI and everything else. You can plug all your contracts in and they can tell you, read it to me like I'm 5. Highly recommend you do that. You can't have it both ways. Investors on one end want to make sure that when they get an IPO that they have tradable equities and that that they're not holding on for a lockup period and then the pop happens and it goes back down and then they lose out on it. And on the other hand, they want to make sure that they get capital out. Which is it? I've never really seen an IPO it's structured in a way where your capital stack day one is a tradable. Like usually they mark the price. You set the price. You're the first shares sold at 135, and then that's what's becomes publicly available. They locked it in. Somebody bought it, and now it's open. So like, I'm not saying that doesn't exist, but it is not typical. So, I guess it's up to you. I mean, no one's going to ask you like, what's your choice here? That's the company wouldn't do that. But like, would you rather the risk of it going up 55% and then dropping down 35% and you have to hold it until it's over? Or would you rather get the money up, see your nice healthy return from $55 to $135, 2.5x? And then if you're so fucking confident in it, then go buy some shares on Robinhood. Go buy more. Like have two different, you can have two different capital stacks. They don't have to be the same. So either way, I feel like that was an easy solution people just didn't look into. To your other question, we'll get to the mirrors thing in a second. To your other question about the SPVs, this is an important thing that this is a good example of what happens, but it's actually a bad example because I think this IPO is so healthy that big, even right. If you have multiple layers of fees, you're still probably getting your money back minimally and probably making a return on it. You're just not making as much as you thought you'd make. Most of the deals I saw, the most recent secondary SPV lasagnas that I saw were at 800 billion. I'm sure there was a couple around over $1 trillion, but it was like 800 billion was the last one I saw. So you figure 800 billion, they're at what, 2 trillion or whatever it is.
1.2x.
What? Yeah. So like 1.2 less 20% to the originator, probably less another 20 to 30. I've seen as much as 40% carry on these. So now you're making like 0.3. Like there's going to be some people who see it and go, we got it at 800 billion. We got out at 1.75 trillion or whatever the number's at, 1.4 or whatever, 1.75, whatever it was. And they're thinking to themselves, 1.5x in 6 months, pretty good money. And you get the money, it's actually like 0.4x. The problem with that is it's all good, right? Because you got your money back plus. So in 4 months, still good work. The problem is not all the IPOs are going to go this way. Most of the secondaries you're involved in aren't going to go this way. And unless they have an exit that substantial where money doubles in 6 months, you would be underwater. There'd be no carry left for you. So
right.
I think
and
people,
you can't just look at the one outcome. Cool. All right. I risked it. Oh, I still made 0.3x. Not that bad. Yeah. But how much risk were you taking? Because in this case, your upside was kind of more capped. So
yeah. So like, I guess the point of this is like there will be more secondary behavior ongoing than ever before. There are entire industry now built on secondaries. I would argue it's more interesting to me than the primary normal venture at this point. I'm more interested in those who I'm more interested in finding those who have found good deals and buying it from them at a risk adjusted rate than being the originator of deals where all the risk is on me. I actually am more a secondary person now than ever before. And I think that market will continue to go that way. Going back to the mirrors while also putting these two kind of stories together, one of the things that I think is important, this goes to the SPV secondary and it goes to the mirror and it goes to Binance and it goes to Kraken and everyone else. It is more important now than ever before that you understand the sources and the connective tissue and who are the deal originators. All the shit you used to spend your time on, finding the data, diligencing, setting up trades, papering, legal. That's why AI is here. It has replaced all this stuff. Your job now is to obtain information that's useful. And useful information to me, and again, not just because I'm connected to the Valor piece, but and Republic, but I would have looked up, Republic has a fund. They've invested, $500 million in a fund. What did they invest in? Go look at their fund. Portfolio is listed everywhere. SpaceX, OpenAI, like a bunch of these companies are on that list. And then you go and look up who invested in Valor and where's their money coming, invested in Republic, where's their money coming from? And you see Valor and you do the math and you go, oh, who's invested in SpaceX? Valor. You can draw a direct line to the investment, which is why I've said that mirrors from Republic, I am a fan of. Mirrors from others who are just going to go out and buy shares later, I think is a little bit suspect. And it turns out it is not nefarious, just a very difficult business because you're selling allocation you don't yet have. So to wrap a bow on this, go back to the SPV piece. If you're doing investments in secondaries through SPVs and syndicates, make sure that the person who's responsible for your SPV or your syndicate has a direct relationship with the company or the fund that initially made the investment. If they do not, you are subject to all kinds of fuckery that I don't even begin to know how to describe. In some cases, it may not matter, like this one. In some cases, it might matter.
I think that's a huge point, because I suspect if some other people out there in the market see how Republic did with their mirror token offering, saw it was a success, are going to try and come out with copycat mirror tokens, right?
Yeah.
You need to ask yourself, okay, they could have everything else all the same with the legal terms and everything else, but do they have that relationship that you're mentioning? Like the fact that Republic had those relationships to the SpaceX shares, you knew that they were probably going to, you didn't know it, but there was a much higher probability that they were going to be good for it versus some other random, Joe Schmo on the internet putting together
and they're not
futures.
They're not like, that doesn't mean that I'm going to invest in every mirror. They have Republic themselves may have a mirror in a company that they themselves are doing what we're saying don't do, which is pre-allocate. And by the way, that's not a bad thing. We talked about it with Binance and Kraken. They clearly told you based on availability. The problem is you didn't think about it, and you don't know. Maybe you assume that they'd have it. Maybe you're not even mad at all, and it just is what it is.
Right. Maybe it's a risk you're willing to take. Yeah.
Right. Correct. But a lot of people, it's not. A lot of people make assumptions, and they're like, "Wait, what?" And then they get all mad, and it's like, this is on you. Part of this game is the risk of allocation, and that's my point again about AI does all the work for us now. So you got a lot of time to go make relationships, and if you're institutional or family office, go fight for allocation in companies that you think are part of a future you believe in. Go get that money, and then you'll figure it out. If you're just going to sit back and rely on other people to make the deals for you, I think that in 2026 and beyond, you're going to have a hard time, because it's musical chairs out there now is what it feels like.
Yeah. Well, let's wrap up that discussion. I think we could probably chat about SpaceX for another hour or two, but always great insights. Thank you, Scott, again for joining us. Let's move on to our next segment. I'm going to welcome Teddy Lyons, Senior Investment Associate at Kingscrowd. We're going to discuss Rejuvenate Bio. Teddy, I'm going to welcome you to the discussion. How are you doing today?
Good. How are you? As you can see, I'm still trying to figure out my lighting situation. I got the shadow on my face.
You look like you're a little bit in a dungeon there. It's all good.
Yeah, that's right. That next episode, it'll be fully fleshed out.
It's because you're hard at work looking in sourcing some of these deals like the one we're going to be talking about today. So Rejuvenate Bio, currently raising on Wefunder. It's one that I know you've been taking a look at, and as our in-house kind of resident expert on biotech space, wanted to hand it over to you to just give us a little bit of a breakdown of this deal.
Yes, absolutely. Something to keep in mind is Rejuvenate actually won the Super Crowd for Good pitch competition a couple weeks ago. So they very, very popular raise amongst the crowdfunding community. And one we're excited to talk about today. So Rejuvenate Bio, quickest kind of one sentence way to describe it is it's a gene therapy company going after aging indications. So as a reminder, and this is something we've talked about on previous episodes with companies like Siren Biotech, but AAV gene therapy basically means that you're using a harmless, deactivated virus as a delivery vehicle to carry a gene into the body's cells and instructing it to do something. So the version of AAV gene therapy that you mainly hear about kind of in the news, etc., is the human indication use cases of AAV gene therapy. So in Rejuvenate's case, they have a human indication that they're currently in the process of developing and going through preclinical studies with. And this is a liver-directed AAV gene therapy where basically an AAV gene therapy delivered to the liver, and it acts as a protein factory to go after aging-related conditions like heart failure, kidney disease, diabetes, and obesity. So it's another sort of human use case of AAV gene therapy. And the science was developed out of Harvard Medical School, out of someone named George Church, who's a very famous expert in the genetic space, one of the most kind of cited authors. And he actually co-founded Rejuvenate Bio. He kind of serves as an advisor these days. But this is science that was developed after many years of research and development in his lab at Harvard Medical School. And something the founder always says is this is no longer a science project. That's what he says in his pitches, because there's a lot of different drugs being developed at medical schools and universities, but this one's actually made it out of the lab, and they're now focused on commercialization both in humans and animals, which we'll get into a bit later. But what sort of makes this a really interesting biotech deal is, and kind of what makes it really investable today, in my opinion, is they are getting this technology approved in the animal health space first, and they've already signed partnerships with 6 major animal health companies, and we'll get into some of those structures in a second. But those development partners, they're co-development partners, and they basically fund, in some cases, the entire development of a certain use case of this AAV gene therapy indication. So I think it makes sense to sort of look through or kind of review 2 of the deals that they have. So I would say the most exciting deal they have, co-development partnership they have, is in a disease called canine osteoarthritis. So that's in dogs. This program is fully funded by a development partner. So Rejuvenate is not going to pay any money to develop this drug for this use case, and they'll basically be collecting $8 million in milestone payments over the next 2 years, and for a projected approval date of sometime in 2029. So this is canine osteoarthritis. There's no disease modifying treatment for it today. Dogs basically just get painkillers for this. And so they've had a lot of great preclinical work that has shown that this drug can actually extend lifespans in animals that are treated that have this disease. But anyway, the second one is mitral valve disease. I think I'm pronouncing that correctly. It's the leading cardiac disease in dogs, and they have a U.S. partner and a Asian partner. And they've structured this deal as there's an upfront payment and a loan, as well as double-digit royalties kind of once the drug is actually developed. So these are the sort of 2 animal health indications that they have development partners on, that kind of really de-risks the development of these drugs, just given that they have a co-development partner that is taking on a lot of the financial risk for bringing these drugs to market. So those are just kind of 2, but they have 6 total partnerships. They're already getting milestone payments. That's kind of why you see that they have around $5 million in revenue. I think last year that kind of comes from some of these co-development, 2.5 million rather. Those are just milestone payments coming in on some of these partnerships. And most recently, they had a press release recently about closing a $6 million financing round led by V Capital and participation from Merck Animal Health. And what's interesting here is the Merck Animal Health, it's one of the largest animal health companies in the country. They actually entered into a strategic research and development collaboration with Rejuvenate to advance gene therapy programs in animal health. So Merck Animal Health is the animal health division of Merck Pharmaceuticals, which is one of the largest pharma companies in the world. So it's kind of the exact kind of strategic partner they would want, and they get funding, get to work in the lab alongside Merck, and really just some validation on the fact that this science has been reviewed, and is exciting for these large animal health companies to co-develop these drugs with them. So lastly, and then Brian would love your thoughts on this one, but another sort of key issue with AAV gene therapy is that it requires hundreds of thousands of dollars, in some cases millions of dollars, to develop doses of these drugs. With Rejuvenate, have a manufacturing moat where, as I said, gene therapy is normally brutally expensive. Rejuvenate's cost is under $100 a dose for animal health, which they believe will also be the case when they kind of move into human indications, which is obviously several years down the line. But for a kind of one-time AAV gene therapy dose, like under $100 of cost of goods sold, is pretty huge. And I think if that eventually extends into the human indications, I think it could be a huge sort of cost advantage and really kind of differentiate Rejuvenate Bio in the space. But anyway, I'll stop there. This is a $59.4 million pre-money valuation, preferred equity. We checked in on the preference overhang of kind of, since they've raised a lot of prior VC funding. Obviously, they have this new round with Merck Health that was actually that $6 million funding round we just talked about, that was at the early bird valuation. So kind of came in at a very similar valuation to what retail investors are going to get if they invest in Rejuvenate on Wefunder today. And so the preference overhang, it's just 1x. So there's not a huge kind of liquidation preference stack that has to be, paid out before investors in this round get paid out. So that's not something you always see. So that's really solid. And this is one where we're looking at closely for Kingscrowd Capital. And I think it's, we're clearly very bullish on AAV gene therapy and with our investment in Siren Biotech. And I think this is another one that in Siren Biotech's case, I would say that was de-risked because of the founder just being an absolute killer. In this case, I think the founder is also great. Dan is great. But this one's kind of de-risked in the fact that they're going for, number one, animal indications first. And even more so, those animal indications are being co-developed, in some case, fully funded by partners. So kind of a unique one here. So Brian, anyway, I talked for long enough. What are your thoughts on this one, and kind of what other questions sort of do you have on it?
I'll structure kind of my quick thoughts and questions in two areas. One's around the company, like the technology, and then the other one's around the deal. Actually, let's start with the latter one first. So one of the things you mentioned, Teddy, right? They got this huge injection of $6 million, right, through this kind of partnership or financing and strategic collab with Merck Animal Health. I think that's huge because it's de-risking it. And, with a lot of these biotech companies, sometimes, right, it is a bit more of a binary outcome, like it works or it doesn't. And being able to get to the trials and see if it actually translates to humans and everything else, right? There's a lot of risk there. It takes a lot of capital. These can be really capital intensive. So when we kind of started this originally, right, it had lower runway. Kind of, we were questioning a little bit about that. So an injection of $6 million, right, in cash, strategic financing, definitely big to kind of help de-risk it. I think the other way it's also interesting that this deal is a little bit de-risked is that it's not just relying on waiting to getting to those human trials. So Teddy, I was trying to think if there was actually another company I feel like that we maybe had talked about recently that did something similar, but it's more of this milestone approach where they can go and actually still get good traction in a market with these companion animals, right? So if we take a look, where they're building it around being able to prove some of this out around some of those different areas that you're already talking about, and then talking about having it happen like with dogs, then kind of moving over and continuing to do the research and everything. So I don't know if you could share a little bit more, Teddy, but just between, is it going to be used in very similar ways, kind of targeting similar things that will translate hopefully from the dogs to the humans, or is it just a similar delivery mechanism, kind of using that AAV, the approach to being able to deliver it through that viral vector that's going to be similar? Did they share anything about that and what that might eventually look like when it moves into humans?
Yeah, I think on the science, so the delivery mechanism is sort of the key kind of step change between kind of today's AAV gene therapy and kind of what Rejuvenate is going after. And a lot of it's sort of with these co-development partnerships, it's the indication that the co-developer wants to work on. So in canine osteoporosis, like that might not have been one that Rejuvenate would have gone after, but they found a co-development partner that will fund the whole thing. So it made sense to sort of go after that one. I think the big question and sort of what the bet is on in some ways is whether the manufacturing side of it being under $100 a dose, whether, if that's under $100 in animals, does that translate into humans? Because obviously human delivery, getting a drug approved in humans is obviously like a much higher bar for, obviously clinical data takes a long time, a lot more money. And in like the manufacturing side of things, it's a different species, so is it going to translate? I don't think there's a great way to predict that, but I think if it does, and even if it goes up by a factor, let's say it goes $1,000 a dose in humans, that's still a huge improvement on AAV gene therapy's costs today. So yeah, but yeah, in totality, I think it's the delivery mechanism is sort of what's the same across the two. but it just remains to be seen whether that manufacturing side kind of translates into the human side.
Got it. I mean, it's a super hot area, right? Just around longevity and research and some of the things that they're looking into. There's just so much out there right now where everyone's trying to maximize their lifespan doing, certain workouts or taking multivitamins and everything else. And this kind of gets to the epigenetic reprogramming side where it's talking about how, the genes can almost be reprogrammed to make them more youthful without actually altering the DNA, which is compelling, right? It's interesting. So if you're an investor, Teddy, taking a look at this, and I know, we're taking a look at this and considering it for the fund, what are the types of outcomes? Like, where does this potentially lead, assuming that if all goes well? Is this something that gets licensed? Does the company IPO? Did they talk anything about like what a successful outcome for investors might actually look like in the future if it does work?
Yeah, I think this is something I should have mentioned when we talked about the new partnership they have with Merck Animal Health. Is I think a lot of these co-development partners would potentially be acquirers down the line. So in my conversations with the founder, they see that there's a path to an acquisition in that sort of $500-600 million range. If you sort of look at the comparable transactions. So I think this is like an amazing way to kind of continue to build the relationship with these animal health companies that could acquire them down the line. They can work hand in hand with Rejuvenate in developing and commercializing these drugs in animals, and just sort of like gets the diligence process like underway almost for them. And kind of spreads it out over many years of working together. That would probably be the best one for investors, and I think probably the most likely. I think if they do get to the point where they are moving along in the clinical trials in humans for their human indication drugs, which obviously takes a lot longer, and they don't have co-development sponsors on that. I think they're going to be using, hopefully, the money and the royalties coming from commercializing the animal health drugs to help fund the development of the human indications. I think if they get that to market, they're going to be sort of more of an acquisition target for like the larger, broader pharmaceutical companies. And that's where, like, if they get to that size, an IPO could make sense. But I think the underwriting of this deal, I think, is you got to just like focus on the animal health partnerships and the traction that they have there, and all those kind of milestone payments, the royalty payments that will eventually come once they're commercialized. That's sort of like hugely de-risking. And that's sort of the human indication side of it is also exciting, but it's not, like you said, that binary outcome of like, this will be successful if they get it approved in humans. It's like, they have near-term opportunities to actually make a lot of revenue on development milestone payments, but also in getting these drugs to market quickly in animal health and getting paid royalties from that. So yeah, I would say that that's sort of the exit path, I think is most likely. But yeah, I think it's definitely an interesting one. And I think having these co-development partners will be huge for the eventual kind of exit down the line.
Yeah. Well, it's just, for this type of company where it is sort of that traditionally it's more of a binary outcome. This one has kind of that intermediate step of the co-development partners, some of the animal indications and other things it could do, where even if, to your point, maybe it's not as successful or it takes longer than expected to get to the humans, there's this cash flow positive kind of place they might be able to get to in the interim, which is really compelling for this type of company.
Yeah, no doubt. And kind of this, they have a lot of venture backing. They, invested in, not only have co-development partnership with Merck Animal Health, like Merck Animal Health actually invested in the company. So I think there's a lot of signaling effect of, that they're really onto something here with this science and this kind of delivery mechanism. So yeah, super excited about this one, and I think will be an interesting one to continue diligencing for the fund.
Awesome. So I think as of the time of this writing, they may have been oversubscribed. So the maximum goal with their filing was 500,000 on Wefunder. Now I know that the current Wefunder page was showing that they've raised 934,000 Did they increase their maximum, Teddy? Has that happened already?
I don't think they've raised it yet, but they're still accepting investments. So I think they are going to be working on it.
Okay. Yeah. So investors can be aware. If you go to the page, it might show, first, it says first goal hit, you can still invest. It's going to show currently 7 million, but that's because Wefunder breaks out Reg D on the same terms, which now includes that 6 million from the press release that we just mentioned. So we'll be monitoring that. If and when they do file an amendment to increase the maximum, that will be updated on the Kingscrowd page as well. But head over if you're interested in checking it out. You can check it out on Kingscrowd, read our full analysis. Teddy wrote a great analyst report on that is written by the analyst team, written and reviewed. So you can check out some of Teddy's takes coming through in that report. And in addition, scored a 4.9 out of 5 stars. So very high rating on this deal. We're definitely going to be keeping our eyes on it. Awesome. Anything else to say, Teddy?
No, all good.
All right. Well, we'll wrap things up there. Thank you, everyone, again for joining us today. We'll check you back here next week when you come back. Hopefully, again, we'll have another great episode. We'll always be bringing you the latest that's happening in the online private markets, investment deals like this, and lots of other good things in the markets to talk about. Until then, we'll see you next time.